Hi everyone, and welcome to this webinar about taxes in retirement. This video is going to take you through the 4 stages of retirement, point out a few different tax torpedoes and tax traps, as well as provide you with actionable strategies to help reduce the amount of taxes that you pay in retirement to help keep your hard-earned income and savings, thus increasing the longevity of your assets. My name is Alex LaRosa. I am a certified financial planner and advisor with Bluebell Wealth Management, a local wealth management firm. For the last 10 years, I've specialized in helping educate and prepare my clients for retirement. Things like portfolio construction, how to take their income, asset longevity, and most importantly, tax and estate planning, which is what we are going to cover today. One thing I want to make clear is I am not trying to sell you anything in this. This is not some kind of a bait and switch video where I'm going to sell you an annuity or an insurance product. I don't even sell anything. My goal here is to educate you. Hopefully every one of you that watched this video learned something new, or at the very least start thinking about retirement in a different way when it comes to taxes. So why don't we go ahead and get started? So first of all, I want to point out that you must seek professional advice always, right? I'm a professional advisor, but I am not an accountant. So anytime you take any of the strategies that we discuss here and apply it to your own situation, please consult with your professional advisor or tax preparer before doing so. So retirement is a new and complex world. For any of you here who are either in retirement or approaching retirement, you are facing big changes in your life. You spent the last 30 some years in what's known as the accumulation phase. You worked, you saved money, you got a paycheck, and you put it away for the future, knowing that someday you will have to live off of your savings. Well, that day has now come, right? And what's different? Well, one, in retirement, there's no more child tax credits, no more mortgage interest rate deduction if you've paid your mortgage off, no more tax-free employer medical insurance, and most importantly, no more contributions to a 401k or a similar deferred compensation fund. What's new in retirement? Well, now you have Social Security. You have things like RMDs or required minimum distributions. Those will be for anyone born after 1959. Those will be for start at age 75. Anyone born between 1951 and 1959, age 73. Anyone born before 1951, that would be still age 72. So, what's the first thing that you need to understand about taxes in retirement? And this is the first stage, right? Which is pre-retirement, leading up to it. You have to know what your after-tax retirement savings picture looks like before retiring. Well, what do I mean by that? The reality is the majority of people that I work with that are approaching retirement or in retirement, the bulk of their savings are in what's known as tax-deferred accounts. So think your 401ks, your IRAs, 403bs, pensions, 457bs. It's money that you've yet to pay taxes on. You've taken a deduction every year that you've put money into it. And now the time has come when you take money out, it will be taxed dollar for dollar at your income rate and it will add to your income. So what does that mean? Well, for an example, if you have a $500,000 IRA or 401k, it's not really worth $500,000 if it's pre-tax. Say you're in the 35% tax rate. That $500,000 is really worth somewhere around $325,000 after tax. If you're in the 37% rate, it's worth $315,000 after tax. In addition, you must take required minimum distributions starting at age 73 or 75, like we discussed. Here's a chart that I'm going to put in that shows the cumulative after-tax value of accounts, and it shows the impact that taxes have over a 30-year period and asset levels. So the first line there on the top, the gray line, is going to show what a 0% rate looks like. Then we move down to the red line there, which is just a 12% effective tax rate, and you'll see the ending difference after 30 years is somewhere around $500,000. Now, jumping up to the 33% rate, which is that blue line, at the end there, that difference is nearly $1 million over a 30-year period. And this is assuming a 6% growth rate of your assets. So at least you'll still have Social Security and to supplement your income and Medicare to pay for your health costs, correct? Well, Social Security and Medicare have tax traps of their own. And you need to plan for them. So first, let's talk about Social Security and how it's taxed. So I want to go through a little tax brain teaser here. So a man named Bill he has income of $48,988. That's taxable income. That's made up of $40,000 worth of IRA income and $37,500 of Social Security benefits. Taking the standard deduction, right, that gets him to the taxable income number of $48,988. Well, Bill finds out that his favorite band is touring in the state over, so he takes out a additional $1,000 from his IRA. How much tax does Bill owe on that $1,000? Well, looking at a basic chart, we see that Bill is firmly in the 22% marginal tax bracket. So logically, we would assume that for every dollar he takes out, he owes an additional 22 cents of tax. So $1,000 should equal $220 worth of tax, right? Well, no. He actually owes an additional $407 worth of tax on that, which is an equivalent of a 40.7% tax rate. Why is that? So let's look at this. So Bill got hit by what's known as the Social Security tax torpedo. So when he took that $1,000 out, what he actually did is he increased his adjusted gross income and his taxable income by $1,850. Meaning for every dollar he took out, he paid tax on $1.85. Well, how is that possible? See, here's the thing. Social Security benefits are taxed one of three ways, and it's depicted by your income. Super low on the scale, somewhere around, under $28,000 worth of total income, which is calculated by dividends, earned income, and half your Social Security benefits. Your Social Security benefits, 0% of them will be taxed, right? Moving up somewhere between $28,000 and $48,000 of that total income calculation, 50% of your benefits are taxable. Well, Bill was in that 50% bracket where only half of his Social Security benefits were subject to his income tax. Taking that $1,000 out pushed him up into the next bracket, which is now 85% of his benefits are taxable at his income, thus getting hit with the Social Security tax torpedo, paying an additional $407, which is an equivalent tax rate of 40.7%. Now, this is a very niche example and very rare, but we put it in here to get you thinking about the different tax traps and tax torpedoes that there are. You have to be aware of this stuff so you don't get hit with it unexpectedly. All right, let's talk about Medicare. So we all pay into Medicare, right? All throughout our lives, every paycheck goes in. So now you get to age 65, you have free healthcare, right? Nope, you still have to pay. And how much you pay is decided on how much money you make, right? Which is essentially a tax. So there's a thing called IRMA, or Income Related Monthly Adjustment Amount. And it's a tiered tax system with different thresholds of income. And as you move up and as you make more money at Medicare age, the higher your Medicare premiums become. Let's look at an example to illustrate this. So we have George and Martha. George and Martha have Medicare as Part B and D. In 2022, they had modified adjusted gross income of $322,000. George and Martha decided to sell stock for a $1,000 gain. So this is in a brokerage account, so it's subject to that long-term capital gains tax rate. So they buy stock for $10,000, they sell it for $11,000. They owe the capital gains tax rate on that $1,000 gain, which for them is 15% plus the 3.8% Medicare surcharge. So that's an 18.8% tax rate, right? So they owe $188. But let's look at this Medicare bracket. What happens is they get hit with the IRMA surcharge. So if you can see here, they're firmly in that $322,000 range where they're paying $349 per month. Taking that $1,000 gain bumps them up to the next bracket, which increases their IRMA charge together by about $200 per month. On top of that, they also are subject to an increase in Part D premiums, which is an increase of almost $40 a month between the two of them. All in all, their 1-year IRMA surcharge is $3,007. Add that together with the $188 of long-term capital gains they paid, and that $1,000 sale of stock gave them a $3,195 real effective increase in taxes. So somewhere around a 320% tax rate on that. Crazy. Again, very niche, very rare, but just these are the things you have to think about when you're making decisions that are outside of your plan, right? Or outside of the norm in retirement. You have to know the consequences. So what other kind of tax traps are there in retirement? Number 3, and this is my favorite part of this video. If you guys take away anything from this, it is this part. You must plan how and when you take your taxable, tax deferred, and tax free assets to manage your income and tax brackets efficiently. What do I mean by that? Well, there's 3 buckets of assets and how their tax is different. We've already discussed 2 of them. So one is the taxable accounts. These are your brokerage accounts. They're after-tax money. They're subject to long-term or short-term capital gains tax rates. So again, you can be either 0, 15, or 20%, depending on your income. The majority of people I work with are in the 15% bracket. You have to be over $1 million of income to be in the 20%. But only the gains that you have in that account are subject to it. So it's not the entire account. So you can be a little bit flexible about how you take income there. You can do tax loss harvesting. You can sell things for losses. You can sell things for not as big of gains as others, but you can be a little flexible, right? Then there you have your traditional bucket. This is what we already talked about with your 401ks and your IRAs, money that you've yet to pay taxes on. Every withdrawal from this, dollar for dollar, taxed at your income rate. Now we have the third bucket, which we have yet to talk about, which is Roth IRAs or Roth 403 or 401ks, 403bs, whatever. This is tax-free accounts. So this is money that you, when you put money in, you do not get a tax deduction, but it grows tax-free and all withdrawals in retirement will be tax-free to you. So there are a few different withdrawal strategies. So for people that have all 3 of these buckets or 2 of them, how you take your income will largely impact how the asset longevity, your tax rates, everything. So your first is a traditional. This is what a lot of planners use, which is suggest spending your taxable assets first, then your tax deferred, saving tax-free for last, because the biggest benefit of tax-free is that time and the tax-free growth. Second strategy is this is called a pro rata strategy. This is a little different. This is someone that has, almost equal or a good mix of the 3, and things are going to be pretty steady throughout retirement. Their income is going to be about the same. So pro rata rule suggests, say someone has $1 million, $500,000 is in traditional or tax deferred, $250,000 is in taxable, and $250,000 is in Roth. If you take $100,000 worth a year worth of income, pro rata would suggest $50,000 of that would be from the tax deferred, $25,000 would be from the taxable, and $25,000 from the tax free. Then you have something called the reverse traditional, and this is something that I've recently used for a real client. This is suggest taking tax free, then taxable, then tax deferred. And why would you do that? Well, again, everyone's situation is different, which is why planning is important person to person, and there's not a one size fits all plan. So for this client, they wanted to retire early, somewhere around 58, 59. They've saved enough, they worked their lives, the plan makes sense to retire. Well, what are the negatives about retiring at 58 or 59? One is you're 3-4 years away from Social Security benefits at its minimal rate at 62. So you're not going to have any of that Social Security income. The other is you're 7 years or 6 years away from Medicare age at 65, which means you have to go to the marketplace to get healthcare. Now, how much you pay for healthcare in the marketplace, a big component of that is how much income you make or how much income you have. So it would behoove you, if you were retiring early and you have the ability to show as little income as possible in those years that you're paying for healthcare through the marketplace. So for this client, and I'm going to put up a real chart here that shows, the expected increase from doing a reverse traditional withdrawal strategy. So we went tax-free, taxable, and then tax deferred when they get the Medicare age. Now this strategy for them suggested an increase of about $844,000 over compared to a pro rata or a traditional withdrawal strategy over a 30-year period. So again, how you take your income can make a giant impact on your tax situation, your effective tax rate, and really how long your assets last in retirement. Next, let's talk about Roth conversions. So this, again, is one of my favorite things to plan for in retirement. If you don't know what a Roth conversion is, the basics of it is you take traditional IRA money and you convert it that year to Roth IRA money. What happens though? When you do that, you have to pay income tax on whatever you convert, just like it was a withdrawal. So if you take a $10,000 conversion and you convert $10,000 to a Roth IRA, you have to pay income tax on that $10,000. So why would you do that? Well, you would do it for a few reasons. One, you think that you are in a lower bracket now than you will be in the future. Two, you can do it through estate planning methods, and we'll talk about that a little bit later. But the most important thing to think about, at least for people watching this today, at the end of 2025, the current tax law is going to sunset. So the 22% bracket's going back to the 24, 24 is going back to the 28, and so on. So at the very least, if you do something now, you could potentially be paying less in taxes than you will in the future. Also, if you're a betting person, if you had to bet on whether taxes were going to be higher or lower in the future, most of you would probably agree they're going to be higher. With $35 trillion worth of debt in the government, I don't see a way where taxes can go down. So, who does this make sense for? Well, a few things have to be true. One, when you retire, you need to have a solid what's called retirement income gap, where your income drops from when you retire and it's low. And I'm going to show a real chart here of a real client that has this. And it's someone who's going to, again, we're going to retire around the age of 60. So they're going to have a drop in income. Now, this person has after tax money. So they have a solid brokerage account and they have solid savings in their bank. They can live off of that money in these lower income years and show very little income because of it. They also have the ability to pay the tax outside of the Roth conversion, which is a very important component of that break-even point. So because of that, they're able to show little income and do partial Roth conversions every year up until they reach Medicare age or RMD age, depending on who the person is. Why would you do that? Again, you could potentially be paying income tax on that amount, be converting it at a lower effective tax rate than you're going to be at RMD age. If you remember in the beginning of this webinar, we talked about required minimum distribution starting at age 73 for most people. Well, if you have $1 million IRA or $1 million worth of deferred income, you could be looking at $40,000, $50,000, $60,000 RMDs starting at age 73. Those could potentially jump you up into higher brackets. So what can you do to help lessen that burden? Well, these partial Roth IRA conversions in the lower effective years. Not only are you paying money at a lower effective tax rate, you're getting money in tax-free accounts that can then grow tax-free forever, but you're also potentially lowering the amount of RMDs you'll have in the future because you're taking money out of those traditional accounts. So you could potentially be lowering the impact that they'll have on you when you're paying for Medicare, when you're in a higher tax rate, all that stuff. Roth IRAs, right? So what we do is, and I'll put this up here, we call it the filling up the bucket strategy. So we may look at someone that's, say, in the 22% effective tax bracket. They have somewhere around $10,000 to go until they reach the next bracket. We might do a $9,000 conversion for them that year. So we don't jump them up a marginal bracket. We don't jump them up a Medicare bracket, but we just keep it all the same, right? All right, let's talk about another tax planning strategy. And this is for someone who's approaching or in required minimum distribution age, someone in that 70 to 73 range. So a lot of you, there's a thing that if you already give to charity, there's a specific technique or strategy that you can use that may be better than just writing a check. Something called a qualified charitable donation or a QCD. So this is a good planning strategy if three things are true. One, as I already said, you're already giving to charity. I never recommend just giving to charity to get the financial benefit because you're still giving your money away and you're not getting a dollar for dollar deduction. And it really should just be, again, you should be doing it because you want to, not for financial gain. Two, you are RMD age or required minimum distribution age. And three, you don't need your full RMD for living expenses. So say that you have a good pension, you have other savings in other places, your RMD is somewhere around $50,000 a year, but you really only need 25 of it, right, for living expenses. So instead of taking that full amount and paying tax on it and maybe jumping up a bracket, you can do what's called a QCD, where you send money directly from your IRA to the charity that you're going to give money to anyway. So instead of taking that RMD, paying the tax on it, and then writing a check, you're just sending the money and you're not paying tax on that. You're not getting a deduction for it, but you're not paying tax on whatever you send to that charity. This is a good planning strategy for people who already give the charity and they don't need their RMD to live. All right. Now I want to talk a little bit about estate planning because I personally believe estate planning and tax planning go hand in hand. So one misconception about estate planning is it's only for the wealthy. That's not true. Every single person should have an estate plan, even young people. At the very minimum, a few things you can do. One, make sure your beneficiaries are correct on all of your IRAs and 401ks. We've seen it firsthand where, someone's on their second marriage, they die, and they forgot to change their beneficiary from their first wife to their second wife. So the second wife is not very happy when she finds out that the first wife is getting, the inheritance and not her. Change your beneficiaries. Make sure they're updated. You can also name contingent beneficiaries. So if you have children or grandchildren, you want to have the money if something happens to both you and your spouse, you can name them on that. All retirement accounts go through beneficiaries. They're not subject to your will or anything like that. Now, everyone else, speaking of which, everyone else should also have the 3 basic estate planning tools: a proper living updated will, a power of attorney, which is very important because statistically, you're more likely to become incapacitated than you are to die, and 3, an advanced healthcare directive. These are 3 things that you can get from a local attorney. If you have a good advisor who does everything, like Bluebell, we provide that to our clients at no additional cost. And then another estate planning tool that anyone else can do, not just the wealthy, is these Roth conversions. Why? Well, the Secure Act 2.0 that was passed in 2020, it changed things, right? So when you pass, your beneficiaries get what's called an inherited IRA. So not your spouse, but your children. Think your children or your grandchildren. They get what's called an inherited IRA. The government wants them to take all of that money out of their inherited IRA within 10 years of your date of death, and they have to pay tax on every single dollar at their tax rate. If you live to your life expectancy of somewhere around 85, 90, your kids are most likely in their highest earning years, meaning they're now paying tax at a much higher rate than maybe you could have. So doing Roth conversions can help that. How? Well, when you die with Roth IRA money, they still have to take all the money out over 10 years, but they don't have to pay $1 in tax because you already did. So doing those Roth conversions, what I always try to work with people is, one, does it make sense for their personal situation? Can we pay tax at a lower effective rate? But do they have children that they want to possibly leave something for? Leaving Roth IRA money is the most tax effective way to do that. Finally, I want to end with something, and this is a little bonus, something I call the silent tax. And this is something I believe is either 1 or 2 when it comes to the biggest threats in retirement tied with taxes. And that is inflation. Inflation's been big in the news the last few years, right? It was at 9.1% at its highest. It's down somewhere around under 3, according to the last CPI reading. But inflation is a big deal. What that is an increase in living costs, which means it erodes your purchasing power over time. I want to put a chart in here that just shows the cumulative effect of inflation on living expenses. So this chart starts year 1, your living expenses are $100,000. And it shows after 30 years at just a 2% inflation rate, 2%. And so if you see here, the 70-year average is 3.3. Currently, it's at 2.9. So just 2%, your $100,000 at year 30 is really $164,000. That's what your living expenses grow to. At a 3% inflation rate, your living expenses more than double at $209,000. And at a 4% inflation rate, you're looking at $100,000 to a $266,000 worth of living expenses by year 30. Inflation erodes your purchasing power. Now I'm going to put another chart on here, and this chart looks crazy. There is a ton of numbers, and what I really want you to focus on is this left side here, the far left box. What that is, it's the average annual returns of asset classes from 2009 to 2023. So I want you to focus on these bottom 2 or 3 here. Fixed income, so it's bonds or bond funds, and cash. Well, 2.7% per year and 0.8% per year. Well, we just said the 70-year average of inflation is 3.3%. So that means if your majority of your assets in these asset classes are actually losing money, they're not making you money. After inflation, they're losing you money. So you have to have a plan to beat inflation. And how do you do that? 1, you have to take some degree of risk. Now that pensions are pretty much completely done with, and now your savings, right? It's your responsibility to save and invest for your retirement. You have to take some degree of risk. You can't have a fixed income. You can't, it won't work over a 30-year period. So you have to tailor the risk to your own specific personal situation. Not everyone's risk appetite is the same. By the book, it always says, 60-40, 60-40, 70-30. That's nonsense. It's dependent upon your situation. Everyone has different goals. Everyone has different risk appetites. Everyone has different incomes. Everyone has different healthcare costs. Build a plan that's specific to you, but you have to take some degree of risk. There is no one-size-fits-all portfolio. So, just to recap here, for the 4 stages of retirement, we have pre-retirement. You have to know what your tax savings are before you retire. Also, use this year to fund some Roth IRA accounts. via either a traditional contribution or a backdoor or a conversion. Early retirement. Understand Social Security and Medicare taxation. Fill in tax brackets in low income years. Middle retirement. Manage your planned RMDs. And finally, late retirement. Organize your assets for tax efficiency in estate planning. Because your tax exposure will change throughout retirement, you need a tax strategy that anticipates how and when you tap your assets to cover your personal expenses, understands the range of taxes you will face at various stages, and manages your actions so you pay the lowest rate possible. So, what I want to offer to anyone that's watched this video is a free complimentary one-on-one visit with me. We can take everything that we talked about and apply it to your personal situation. Plus, I will give you a free retirement assessment using our state-of-the-art financial planning technology, where I can give you a number that gives you a little bit more clarity on where you stand in or as you approach retirement. I can also give you a free and complimentary tax report that can break down exactly what your tax situation is, as well as build in scenarios that can, make decisions in the future for any tax strategies that you might want to implement. This one-on-one visit has no cost or obligation. Click the link down below. You'll find my calendar where you can schedule a call with me and we can set up our one-on-one visit. Thank you for watching and have a great day.